Rob McEwen has a habit of making bold predictions about the price of gold, and once upon a time it was, shall we say, easy to dismiss them, like when bullion was trading at $350 an ounce back in 2002, and Rob said it would hit $800 in 7 to 9 years. Well, as we know now, it turns out he was a year early, and those predictions aren't so easy to brush aside anymore. Rob McEwen is chairman and CEO of U.S. Gold and the founder and former CEO of Gold Corp, the world's second largest gold producer. He is with us in New York this morning. Rob, great to see you again.
Morning, Erik.
You've been on the record since March of 2006 and possibly before, saying that gold will hit $2,000 by the end of 2010. The end of 2010 isn't far away. Gold isn't trading really anywhere near $2,000 right now. How soon before the end of 2010 you think it could get there?
I'm saying by the end of 2010 we're at 2,000, and before the cycle's over we'll be at over 5.
Okay, let's talk about the cycle, because $5,000 is a bold prediction indeed. What is the cycle? How long is it going to take for bullion to hit $5,000 an ounce?
I think we'll see it in 2012, 2014.
2012, so literally 2 years from now, less than 3 years.
2 to 4 years, you're going to see it at 5.
But possibly less than 3 years from now, we might see gold hit $5,000 an ounce. A lot of people have trouble believing that, or at least even given your great record as a predictor, coming to terms with the idea of a $5,000 gold price economically. So walk us through your rationale.
Well, most people don't even look at gold as part of their portfolio. It hasn't been part of the portfolio theory for 20 years. So it's absent. It's underrepresented in all portfolios. And but it's been the best performing asset in the last decade. It's been up 15% a year. There's no other asset class that's performed as well as gold. Okay,
but the conditions around gold trading have changed, though, since, say, 6, 7 years ago when gold was trading at $350 an ounce. There are ETFs that hold gold now. There are Wall Street firms that much more aggressively trade commodities. That's a completely different picture from the way things used to be. Don't you think some of that is already built into the gold price we see today?
Well, money supply has expanded so rapidly that there's a lot more dollars looking for a safe home, and gold fulfills that function. This is once 2 or 3 times in 100 years you're going to see an event like this. This is a third cycle for gold in the last 110 years. Governments can't help themselves. They want to help the economy. They're printing money. They're going into debt on a horrific scale, and that will depreciate the value of the dollar.
Back in 2004, when you were talking about gold hitting $850 in 6 to 8 years, you had modified your forecast a bit. You talked about gold being in the beginning of a bull market that would last about 6 years. Well, we're at the end of the 6-year period. Why is the bull market continuing?
I was wrong.
Well, I mean, is it for the reasons that you just explained?
Yes, gold was treated as jewelry, a consumable. Today it's being treated as money, an alternative currency. In fact, the best currency compared to all the other fiat currencies or paper currencies. Okay,
a lot of people listen to what you say and they think about Rob McEwen, they think about your role at Gold Corp, and they say, this guy's just a gold bug. Disabuse us of this notion. Why are you something other than a gold bug?
I'm a student of economic history, and when you look at cycles like this where people disrespect the value of the currency and print abundant quantities of it and borrow without restraint, that leads to a falling value of the currency. And that's what we're seeing throughout the world right now.
Other companies have, shall we say, embraced your vision for higher gold prices. Erik, among them, the world's largest gold producer, ending its hedging program last year, which cost it dearly in terms of lost profits in the past, and ending those hedging contracts costed a whole pile of money to get out of them because it was locked into lower prices. In your opinion, and I'm almost certain you're going to say yes here, is it crazy for gold producers to hedge at all?
Right now, it would be a dangerous precedent.
How about business practices in general? When you look around the gold mining world, who's doing it the best?
Who's doing it the best? Erik does a good job. They're very thorough, but they're the largest. I think what you want to see is people using new technologies, alternative energy sources, looking for other chemical reagents, so you have less of an impact on the environment. Would be a very wise place for the industry to go.
All right, Rob, it's been great to have you. Chairman and CEO of U.S. Gold, founder and former CEO of Gold Corp, the world's second largest and lowest cost gold producer.